So
Yeah.
we've talked in theory for quite a long time, right? So let's go to one typical example.
So the example I show here is for the liners. Liner have two options, right? There's always a cargo, so customers that they're willing to give the cargo on a fixed price. But the issue is about the price, right? If the customer give you a price, is that there's a loss making. The price from the physical side is lower than the futures.
Yeah.
Then for liners, I have a shipping slot. So my only action is to sell.
Yeah.
So it's a matter of who I sell to.
Yeah.
I sell to the future trader or sell to the physical guy. So if the physical guy give a good price, so then of course, so then get the fixed price, get the cargo, and then no need to worry about the future.
Yep.
But if the price from the physical side too low, then I may consider selling to the future. So the starting point is for the liner to pull the triggers. I would do it only when the future for a higher price. Then the current scenario is I just take the current price for the August contract.
Yep.
So that's around 2,000. I use the Shanghai, then there's Asia Europe route here. So we didn't talk about it. So the conversion of index to price.
There's a multiplier, yeah.
Yeah, there's a conversion, but the conversion is not really a fixed 1.5 or 1.6 from index to dollar per FEU. So 2,000 index, the price around 3,000. So for August 3,000, then for the liners, you can actually take it and then earn this 3,000 regardless how the actual physical market price will turn out.
You can lock in the 3,000. Yeah.
So customer think, oh, August, so this year the peak season may also end earlier like last year. So they don't want to commit or they just want a very low price. So then you short sell the future and then you tell the customers, I go with the floating rate, but to give you incentive, so to give me this commitment, I give you a discount.
Yep.
In August, whatever the future price is, 1,000, I give you $200 discount.
Yep.
So, and if it's a 4,000, I'll still give you the $200 discount. But then you actually, as a liner, you effectively lock in 3,000 minus a 2,000 discount. You actually earn 2,800, regardless of how the fixed rate eventually go. So the upper scenarios, if the fixed rate go up, so that is the opposite of what the customers want. The fixed rate go to 4,000. So since you want an index link minus 200, then the customer will have to pay you 3,800. And then you will make lose as a liners because you short sell to the future market.
Yep.
So the 3,000. So you actually lost 1,000 because your price is 3,000 here.
Yep.
So you actually lost 1,000 to the future market. But then you earn more from the customers. Net, you actually earn 2,800. So just same as your original plan. And then here's in the spot market, if you go down to 2,000, then okay, so you make money because you short sell 3,000. The price go down, you earn 1,000. And then, but you earn less from the BCO as well. So your promise is whatever spot minus 200. So you, in this scenario, you get 1,800 from them. So same, however it goes, however it play out, so you will get 2,000. But the two different outcome is in here, you are the one who lose money. So the one who gain is the future market. Then of course you have an issue about if the BCO will show up, because he had to pay much higher fixed rate. Yep. So even if he doesn't fulfill it, he go to the spot market and look for other slot. Oh, his chances that he had to pay 4,000, 3,800. So hopefully the 200 enough to lock him in.
Yep.
So and then of course as a liners, you lose optionality to earn 4,000.
Yep.
But then you earn the certainty, 1,000, 2,000. So that's why I say, so when a liner to use a future, you like the scenario that you are actually using the future in the down market.
So basically,
because a loser in the down market is in the future market. The BCO will get benefit, you get benefit. The loser is a future market. So this one easier to execute.
So if I say it differently, right? Yeah. So that scenario works really well when in early June, when the market went to 6,000 and you use that level to short sell.
Yeah.
That's the scenario. When it was at 2,000, you short sell. That's a bad scenario because if it goes up 6,000, the biggest risk you have is what if the BCO decide I'm not gonna honor my contract, and then you're stuck. You lose on the future side because you went up and you don't get a cargo. So in effect, what you're describing here right now is as long as the contract is still a bit iffy on the BCO side, you need to actually do when you think the rate is already high, right? Effectively.
That's one, or you really lock in the BCO. then
But technically, if they come back,
you still have some buffer.
yes,
Because
you have 2,800 buffer.
Because you think about your costs, you lock in 2,800 as an income.
Yep.
The liners, the break-even levels, it could be just around like 1,700.
Correct.
So you have 1,000 buffers that you can
still play around with. And then the customer, technically, they feel really great because
they still buy lower
they spend a spot. So technically, it's still good trade for them. Right?
Yeah, still buy. Because the beginning of the premises is I already offer, but if the customer willing to pay me 3,000,
yes,
I'll take it already.
Yes, that's true.
So but then the customer want much lower rate.
Yeah.
So at the same time, because the customer unable to commit in the future price level, you give them that. You think the market will go down to your index link.
So what I take away from this is I think there's still the biggest uncertainty still is would the BCO honor the contract or not, and that's why you were saying earlier. One of the risk management perspectives is to make sure that on the future side, the future lose money and you're making money. Then you lesser the risk of the BCO. But I think the way I read it also is if the arbitrage value is high enough, your cushion is enough to compensate you even if they don't honor it. That's also
you get sufficient.
Right. If the cushion is very small to do this kind of thing, it's very dangerous. So I guess the other thing about it is if rate is low and people are not that willing to commit, still like if people want to walk away, play the game, don't use that as a hedge instrument. That's very bad. But if rate is very high and you have no way to lock people in, this is the right way to do it. Because very likely rate will go down, as we know in this market, right?
For liners, wise, you have the whole ship of potentially few thousand TU slot right, for your allocation, and then like, let's say you pay it to lock in like a couple hundred or 500. You're sure you actually you can pair with some physical.
No, actually I don't read this way. I actually think even this scenario it cannot make sense because. What happened is if the scenario happened again, right? You have very high rates, you cannot really lock in people. This is a way to lock in and it's risk-free, right? And then obviously the scenario where rate is very low going lower, this doesn't help, but that's always the bad scenario. The only thing you can do is blank selling and then try to take capacity away to prop up the rates. But future is not going to solve that problem, right?
No.
But at least in the good scenario, you have better control, better way to hedge it. And hopefully people start to use this. You can also enforce people to follow the contract BCO and make the market healthier. Right?
So let's do one more. So for BCOs, you have cargo, you have to buy slot. Your natural positions, you're short in slot. So that's your starting point. So you have to neutralize it by buying slot, right? So you only buy from the future market when the future price is lower than the physical price.
Of course.
That's your starting point. So you see that the liners quotation is much higher than what you see in the future market. Then you should long in the future market. So then tell the liners that okay, well you should give me an index link in the slot side. So you get a committed slot finance for BCO to do it. Financially you have less risk than the liner to do it. The liners are worried, the BCO will walk away. I don't have the cargo. But usually the BCO will get the cargo. The liner will take your cargo as long as there's agreement. But it's just that the liner may roll your cargoes a couple of weeks. I take the example here is for October this year until April next year. So it's October year 2025 to April 26. So the average price around $2,000 for 40-footer. So then you buy 2,000. Then of course, one is the future price need to be lower than physical, but you also need to decide you really want to do that business.
Correct.
To distribute at all. Right? Let's say the 2,000 give you a profitable business, and this 2,000 also lower than what you get from the liner. Then you should actually long the future. Because by long the future, you basically lock in your cost at 2,000. So same scenarios, either the freight rate go up or down. Right? Let's say the freight rate in December becomes 3,500. So it's a surprise up cycle. So because you long in the future, entering at 2,000, so you actually make 1,500 when the freight rate go up. So you make a profit in the future market. So but then you have to pay higher freight rate to the liner because you sign the index link. So the net plus 1,500 minus 3,500, you get 2,000. Just same as how you planned for. And then if the freight rate go down, that's your long position in future. So you lose money in future. and then you paid lower fixed rate to the liner, so 1,500 then 2,000. So you add it together. Actually, so sorry, so this one's wrong. The slot cost is not 500 here, so I need to correct. It's 2,000. So either way, so 2,000 so for fixed cost. So, but the two different scenario here is, so a BCO, when you want to long future, you like to long it when you have a higher conviction, it's upcycle.
Yeah.
Because when it's upcycle, the losing end is in the future market.
Yeah.
So, but then usually even the losing end is in the physical market. Actually, usually there's not. You don't have the risk of the liner walking off.
I feel, as you say, if the carrier doesn't move away, maximum they will just roll the thing next week, then it's not real risk. So my takeaway is this product, the BCO should do it.
Yeah.
No risk for you not to do it. Carriers, be careful. It depends on the situation.
Yeah.
Level of the rates and what the expectation of rate will do is important as well.
Yeah, yeah, because the liner has a risk of the customer not sure.
So that I think that's the nuances, right?
Yeah. So from this one, so from the fixed forwarders, actually what I'm showing here is sort of arbitrary. The fixed forwarder usually have both buy and sell side, unlike the liner. So fixed forwarder starting with a neutral in the slot. In this scenario, so forwarder can use future. So both either the future is higher than the physical or physical higher than the future. So in here, so the future is higher than the physical.
The forwarder should be buying, you mean?
Yeah, the forwarder should buy from the liner at a fixed price and then short sell the future. If the liner quote the 2,400 and the future is 3,000, so then you lock in the 600 already. Then you can lock in. Then at the same time, you look for a shipper that willing to take the floating rate, and then you can give incentive to this shipper floating with a discount.
Yep.
So it doesn't matter wherever it go. So your math will still be the $300 profit. So for the forwarders, this kind of structure allow them to go for volume actually. Because a lot of time for forwarders, if the liner give a lot of slot, I don't feel I may have cargo. They pay enough to take it. But if I know that I don't really take the financial exposure fully.
Because I can short sell it.
Yeah.
And if it's okay, got it.
Because for shipping, right? So even in a bad market, the ship will still be close to 90% full. It's not like you don't have sufficient cargo. So if you are willing to go, so give away more of your gain as a forwarder, you'll get cargo.
So the way to think about it, it's actually going back to the forwarder being a broker and to manage the risk for the carrier, essentially, right? I'll take some more risk away from you, repackage it, figure out how to source the thing, and using this allows me to take less risk. As opposed in the past, I wouldn't be willing to do that because what if I get stuck with the extra volume I took away from you?
Oh, sure.
That's effectively what it is.
When the future market is mature, I will see a lot of forwarders coming as a counterparty.
Exactly.
Yeah, for both the cargo owner.
They effectively a broker.
A lot of big fixed forwarders, they have their own treasury function.
Correct.
They can issue option.
Yes.
Yeah.
That's what I was gonna say. I think if future really takes off, if you have option trading, and I don't expect shipping line to trade option. I don't expect BCO to trade option. I expect totally the savvy freight forwarder, the German ones, to really start to trade options. Because it totally makes sense for them, right?
Yeah, totally. So for them, they can be more market neutral than today.
If I'm guessing, this market will be huge for option writing because of the realized vol should be quite high. Therefore, a lot of people want to offload the risk, and as an option writer, actually be very, very juicy.
Yeah, we had to get down to a number though. So I just think for things that's very volatile, the option price also maybe not low enough
to convince a buyer. But then I think you move the strike, right? If you move the strike out of the money enough, there's always people who would take it, right?
Yeah. And also because a lot of shippers, the cargo owner side, many of them don't have the treasury function or don't think that they can manage the actually trading futures. They will be more inclined to buying option.
Yes.
Just buying insurance. So today, for a lot of cargo owners, the volatility of fixed rates is really a killer for them. So they can off all their profits from their 10% shipment profit margin.
So actually, it is compared to a financial market. The BCO are basically the retail guys. The freight forward become the market maker, option market maker, the market maker, option market, the Optiver, the SIG, and then the shipping line effectively are the natural. They manufacture this asset that exists, right? So they're
manufacturing the slot.
They're manufacturing the slot effectively. That's how to think about it.
Yes,
That's really interesting. The financialization of this industry, I think that could be very exciting, interesting area.
Yes.
Yeah.
But what we talked about, the pain point for shipping, so volatility, unpredictable freight rate, the major pain points about the level commitment from those contracting parties.
Yeah.
For they cannot commit just because the freight rate volatile, not totally to their disadvantage. They can only walk out.
Yeah.
So, but these instruments, in the long term, will help the industry to function more like the other industry.
Yeah.
For other commodities, they don't have a buy and sell, easily walk out from deals.
Yep.
Yes, and then the credibility loss is so huge for them.
Yep.
But in shipping, just because walking out from contract just so being used so widely.
Yep.
So sometimes the party that actually commit these kind of things, they don't see it as a big credibility loss for them.
Yeah. I think if this market becomes more widespread, I use future to systematize the risk management to smooth down the risk, then you can sell more value-added services on top of it, because price is not a differentiating factor anymore. Therefore, next is services that you have to provide. As long as price and availability is the main driver, people will never pay for all those innovation that you want to do, right?
Yes, it is a game changer. Those are very old instrument in many other industries, but this one give container shipping innovation in a way because it's new to our industry.
Let's say after this episode, some board member at Maersk, at MSC, at Costco, they've watched it. They say, this is a great idea. Johnson, that's a great idea. What's the next action they need to do in order to start to take advantage of this opportunity?
That's actually two angles I want to answer. One is actually quite important that the shareholders, the board actually need to know this instrument. You need to know this market exists.
So first they need to call you to do the training first to teach them the market.
Oh, we could. To walk them through the actual scenario about how to trade and all this. Hey, actually, that's another way to manage.
Your business is completely different.
Yeah. Your business could be managed in different ways to use these kind of instruments, and it's available now that wasn't available before. So that's we need to communicate. This message still need to go out. I think a lot of us in the industry, a lot of our peers in the industry, the stakeholder, the shareholders may not have heard of it. When they know it, then the good example that I could see is that the one that I've been speaking to is they really put a working group. So they think about in the organization who's suitable to do it. Yep. Put them together. So at least as someone who actually have experience in trading stocks.
Yeah, at least, yeah.
If a line manager never even trade stocks, chances are they won't be bothered to learn this kind of thing.
Yeah.
So one example I like to use is the steel industry in China. They're also very traditional. They're even more traditional than container shipping, and the SOE is more reluctant to do any changes. But over the last 10 years, I see that the steel industry actually they combine future trading and their daily operation, and then even their sitting plan change.
Right.
So you go to some of the commodities or steel mills or commodity trading house, line managers and the one who make the fiscal pricing and the one who actually manage the future book, they sit together.
Yes, they have
and
to.
Then in between also have a risk manager. So then they constantly communicate with each other. Okay, so there's a lot of intelligence they can change, and also when they make decision, they make it together.
Yeah.
The last thing is you just have to try. You go through the motions. Don't do big, and then also don't do margins. Don't do more than your fiscal exposure.